Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com. Now over to your host, Sparta co-founder and CEO, Felipe Elink Schuurman.
Welcome, everyone, to this week's episode of Sparta Market Outlook. I'm Felipe Elink Schuurman, your host, and today I'm joined by Phil, James, and Jorge. Phil, hi, how are you? All good?
Good, thank you.
Recovered from karaoke last week?
Yeah, it was a good get-together.
Yes, we had our get-together last week, all the company or the commercial team, and we discovered that both Phil and James have an exceptional voice and should be participating almost professionally in a karaoke contest.
You're being very generous there, Felipe. James is the singer.
Yeah, and you put up quite a show, James, as well, huh? Not just the voice, but just the whole entertainment, the whole package.
Yeah, it's important to be confident in these things. Go for it. Sure.
And Jorge, we missed you, but welcome to this episode. How are you?
Hi, Felipe. Very good. Yeah, and you must be glad that I didn't went to the karaoke.
Yeah, it was not raining in London that day. Maybe it's linked. So we have a packed agenda today for you guys, covering all kinds of things, including obviously Trump's tariffs on Canada and Mexico, all the ripple effects of the sanctions on vessels, particularly, and the impact it has on the crude market, obviously around all the dirty freight vessels that were sanctioned and how is that affecting the market. So let's start with our usual section on what happened this week. Phil, maybe you can, fill us in on what are the key moments of this week.
Yeah, I'll keep it relatively high level. Starting off with, it looks like we've finally found something that can make those US Gulf Coast refiners cool off a little bit. There have been a couple of reports now of a handful of refineries taking a little bit of a break through their freeze in Texas, but actually the majority of the system seems to still be online, and maybe it's more of a logistical thing. So maybe we just back up some of those exports, but overall, yeah, maybe we've found something to take US crude and take a little bit lower, at least for a few days, whilst they have a kind of a bigger threat on the horizon, I suppose. So Trump has postponed his 25% oil tariffs, which are still not particularly well defined, but until the 1st of February. So whether that is room for negotiation now or just time to kind of draft up the wording, we don't know. There's no additional news on Russian or Iranian measures, but okay, we're only on day 2 of the new administration, so there's still plenty of time there. And going back to those OFAC sanctions, we still see that fallout. So we'll talk about this a little bit more in detail later, but the Middle Eastern crude complex keeps running higher, and as well as the dirty freight systems, but those are starting to come off a little bit now. So we'll talk about kind of why that is and timings on crude purchasing and everything like that. But it's starting to come off just a little bit, I think. So the picture now is more shifting into the Atlantic basin and seeing how those pricing shifts that we've seen in the Middle East are going to impact crude out of West Africa next. So our tool, the crude arbs tool that we've built, is showing that there's a lot of opportunity at the moment for WAF grades. They're pricing very attractively, and we'll go into that in a little bit more detail, but that's something maybe to keep an eye on over the next few days.
So let's just pause here for a second. So very interesting, so the whole action or naturally the impact has been essentially on AG, crudes, given the sanctions, etc. But it seems like the market has forgotten or not paid enough attention to WAF, and there's a discrepancy there. And therefore a great opportunity, correct?
Exactly, and it may simply be a timings thing, and there's a few other factors to consider, and because WAF crudes are linked to dated Brent, obviously, which itself has been moving higher, and we have kind of Brent Dubai widened a lot, which has made those WAF trades kind of less attractive without having to see their own FOB premium move higher. But as the kind of we've got, and obviously freight moved up as well. So there's a few kind of factors that made WAF grades already slightly less attractive without having to see their FOB premium rise. But those things are starting to come off now. So certainly I think kind of one of the highlights of the crude section is going to be looking at whether, if you are someone who has WAF crudes to place over the next week or so, where you should be looking. And actually, I think that you should have an eye on maybe trying to squeeze a few extra cents out of those cargoes if you can.
Okay. And maybe worth mentioning as well, an update on the nat gas situation.
Yeah, just a very quick one, because I mentioned a couple of weeks ago that I like to keep an eye on these kind of things. And January so far, probably not a surprise to anyone who's living in Europe, but it has been cold. And we've had really sizable draws on gas stocks. So we're now down at 60%. We're matching exactly the trajectory from 2021, which obviously 2021 was the year that then really set up the very high pricing at the end of through the 2021-2022 winter. Now it's not going to get to that stage again, but it does mean that we're looking good for a kind of higher for longer price situation on European nat gas.
Fair enough. So we also have an update on Jody. November data is out. What can you tell us about it?
Yeah, so it was a confirmation, I suppose, of what we'd already been talking about, or what we'd felt already from products pricing, that November European crude intake was significantly higher month on month. And if we kind of extrapolate that out through what we were seeing in product pricing and crude pricing, it's likely that crude intake remained high through December as well. Distillate inventories on the back of that seem to have remained a little bit higher year on year. Distillate demand wasn't fantastic in November, but that could be revised up with German numbers typically, or not always being the most reliable on the first Jody run. So distillate demand in Europe wasn't fantastic. Inventory is now higher year on year in particular. And I suppose the other thing from the Jody data is then Mexican crude intake. I remember over the end of last year when we were looking at Mexican crude intake from Jody data, it was a little bit disappointing in the previous months, but November's really ticked up higher. And we can kind of circle that back to the conversation on crude tariffs now potentially, and how it's going to be really important that Mexico, the Mexican crude system or the refinery system, can absorb as much of that crude as possible, because obviously if it is a 25% tax, it's very unlikely that those crudes are going to be able to make their way into the Gulf Coast as they typically do.
Yeah. And on the weaker demand on the distillates, I think that James will talk about that later on, but
Sure.
it seems that it has changed. It's that we've seen a much stronger demand over the December, January, and obviously the expectations of a higher demand, which paints a different picture too, and it is obviously reflected on the price. But we'll talk about that in a second. And just before we talk about distillates, in general, there's our margin indicator on the east-west is diverging. Maybe, Phil, you want to finalize on that?
Yeah, it's been a slightly, and we're going to talk about this obviously on the distillates and again in the gasoline sections, but it's been a slightly surprising kind of reaction to the price movements over the last week or two, that delivered crude has gotten much more expensive into Asia, but product cracks haven't responded. So it seems like the market is either happy to say that utilization needs to be lower in the east, or there just hasn't been that reaction yet. So at the moment, it looks, Northeast European simple margins are up 70 cents over the last 10 days or so. Singapore margins are down 50 cents, and they had been tracking very closely. So and the same has been seen on the complex margins as well. Those in the east have kind of really diverged from the west, and it's difficult to see why necessarily in the short term.
Yeah. We'll talk about the gasoline cracks and particularly in spreads who have collapsed in the east in a later on. No, that's I have to say that on our side it's quite unexpected, but Jorge, you'll tell us more about that later on. No.
Yeah, that's gonna be the main topic today for latents. The correction we have seen in the Singapore 92 market, and as Phil said, we were not expecting that, at least such a big drop.
Yeah. No, definitely not. So, talking about that divergence and moving on into distillates, James, you were
Yes.
broadly bullish distillate, and we've seen from a variety of factors spreads, particularly spreads and cracks, but mainly spreads going up significantly over the last
Yes.
week. What's the status in distillates? What do we do from here? What has happened? Tell us the whole picture.
Yeah, well, I
Maybe
was
you can
bullish
sing the
move.
whole picture,
Yeah, no worries. Well, I was bullish moving into Q1 anyway, but I think it's
Yeah.
fair to say that the Russian or the anti-Russian sanctions have really kind of propelled distillates a fair bit. So we said the general trend has been a positive one for global distillate cracks since and slightly before those anti-Russian sanctions were announced. Although cracks, particularly in the East and in jet, have kind of faltered over the last few days. Whereas if we move on to kind of spreads, they've really continued the upward momentum since the Russian sanctions, really, particularly heating oil spreads, due in large part to the cold snap we're experiencing, well, in Europe here as well, but particularly in the US, in the US Atlantic coast, and also the effect of that cold snap on refining operations in the US Gulf Coast. We've also got the imminent or very soon to start turnarounds in the US Gulf Coast there as well, which is kind of giving extra strength to heating oil spreads. However, in ice gas oil and Singapore diesel, I think there's been like a certain amount of profit taken over the last few days after the surge we saw in these spreads after the sanctions. So as Phil was talking about before, the weakening of Singapore diesel pricing has also combined with that of gasoline. And maybe we should start to think about the reduction of runs in the East at some point, or particularly as they move on to kind of the Feb or the end of February, March crude buying program as well. However, kind of maybe counteracting that a little bit, we've seen that due to the narrowing of the gas oil and jet east-west over probably the last week or so, and despite the dramatic widening of the Singapore regrade that we've witnessed, Middle Eastern, Indian cargoes for both jet and diesel should be pointing east still. Although I want to say one important caveat there is that we should see some flows of this jet still move west because we're seeing that these jet cargoes from the Middle East are open arb-wise into the US Atlantic coast for like those reverse TA moves. And actually that's something that's been quite mirrored in diesel as well, where we've heard and seen fixtures of reverse TA transatlantic flows from Europe into the US Atlantic coast and Florida over the last week or so.
Very quickly on that, James, sorry. The jet arb is open into Pad 1 out of the Middle East. Is that right?
Agreed. Yes.
Okay. So
How
is that
common is
typical?
it? Yeah.
Yes, I think there's just been extra demand. Well, so let's be very clear about that. We've seen some weakness in European jet and weakness in Singapore regrade. And despite that, I think weakness in Singapore regrade, if you compare those two to each other, Europe against East, those ARBs should be moving east. But actually, because of that continuing reduction in regrade, it's not been enough to price these barrels into Europe, but actually it has been enough to price these barrels into the US Atlantic coast. And that's why that ARB has opened. Mostly. Now, we've also seen the HOGO continue to widen for the similar reasons we spoke about before, the cold snap in the US, the start of turnarounds in the US Gulf. And as such, the US Gulf transatlantic ARB, diesel ARB, still remains closed to Europe. However, I want to kind of mention there that we've seen a real decline in Brazilian diesel premia over the last fortnight or so. And as such, we've actually seen that the margins to go for diesel from the US Gulf to head to Europe versus those of like Latin America, Brazil, are actually better. So though I think we're going to see quite a substantial decline in these transatlantic diesel flows into Europe over the next period of time, I don't think it's going to move to like historical lows, essentially, there.
You said that diesel transatlantic arb was closed. Obviously, I can see the numbers. I'm looking in the platform. It's quite closed, right?
Yes, but the thing is, I want to be very, very clear, and I think with our ARB calculations, is that when we say the TA ARB is closed, it's never zero, right? It's minimum of probably a month, 600 KT. That's kind of the minimum you've ever seen historically.
Yeah, there's baseline stuff, there's termed up stuff. Yeah,
I guess I'm saying that normally it's for a US Gulf trader, the first thing he wants to do is place it in the pipe normally, then send it to Latin America and send to Europe. I think probably the pipe ARB is open because of that demand in the US Atlantic coast. And what I'm saying is I think there's going to be a reduced pull from Latin America, freeing up more barrels to move to Europe. Lesser than probably the average number, but not historical lows of diesel.
So probably good for a good time maybe to actually see those inventories in Pad 3 move higher potentially.
I don't think so actually, because of the start of the US Gulf turnarounds very imminently and the effect of
There you go.
on
Yep.
US Gulf refining operations because of the cold snap we're having right now.
Okay.
I hear some doubt in your voice.
No. No. I think it was just it looked to me as though the US is obviously pricing to export less distillate, and so
Agreed.
you're obviously you've got that base flow that will head to Europe as it always does. But I think the kind of the marginal or the discretionary arb transatlantic could be zero if at current levels. It's rare in the history of our kind of calculations that we've been doing for the last couple of years to see the prompt arb is it's closed by 5 cents per gallon, and that's despite TC14 coming off a little bit. So, and obviously you said also the Brazilian kind of pull is also looks weak. It looks as though Brazilian demand isn't fantastic. So it does kind of just look as though the US is pricing to export less out of PAD 3.
Yeah, that's one view. I guess I don't agree with it. I don't think it will be like historical lows for diesel transatlantic flows this month. I guess we'll see. But I think we kind of have generally the same view that we're going to see substantially reduced flows from the US Gulf into Europe.
What needs to happen
diesel.
then? European prices need to go up. US
Indeed.
prices need to go down.
Yes.
What is the anomaly here that needs to be corrected?
This is part of the reason why these US Gulf turnarounds, the effect on reduced flows TA is why from here, where are we looking at now? ICE gas oil spreads, I think in the prompt $5 per metric ton. I would be looking to get bullish here. Even though we've seen a little bit of profit taken over the last week, I would be looking to stay long up until $8 or $9 per ton on that front spread.
Okay.
From here.
So that's interesting because again, let's not forget where we're coming from. And we're coming from a year where being cautiously bullish was the biggest bullish factor you could have. No one really saw that any kind of bull trend could have legs. And this is the first time we're seeing, obviously exacerbated with the
sanctions.
The sanctions and the weather and all of these things happening at the same time. But can we say that there is a momentum here, that is different to the sort of spikes that we've seen over the last months, and this time is slightly different? I'm not saying this is a rolling backwardation for forever, no, but is there a different scenario now that we've had versus the last 3, 4, 6 months?
Yes, I would say now that we have turnarounds starting in the US Gulf, Northwest Europe, we have the increased demand from a cold snap essentially in the Atlantic Basin. Yes, I would say structurally it feels more bullish than say if we were talking about the end of Q4.
Sorry, so for listeners, it's like, if we're in this bull mode, okay, what are the factors that one needs to be looking at so that you can start saying, okay, I want to get out of my position or I want to be more cautious about this bull run?
Yes, I would be monitoring high frequency data such as EIA for US diesel demand levels, JODI levels for kind of views about European demand. And also, I think the data that Phil mentioned about refinery margins are very important as well. We're still seeing those very poor refining margins in the East, for example. So when we start to see those really increase and therefore runs come back, that would be another thing that I'll be looking to monitor.
So you're saying the runs are actually not fully running in the East right now?
I'm saying that refining margins are poor in the East.
Yeah.
And I think that is going to lead to some reduced runs maybe coming up mid-February to...
So you're anticipating one of the reasons why you're bullish is because you also, not only the weather, the higher demand or the Rs being shut, but also the fact that with these margins, there is a potential for reduction in runs, which will exacerbate even more this situation, correct?
Yeah, indeed. And that's, again, part of the reason why I'm bullish diesel is that I think the cracks and the spreads, well, the cracks most pertinently need to do the work of fixing the refining margins.
Correct, yeah. Okay, so the consequence would be that margins improve on the back of, higher demand, let's say, or a pull from Europe, which then increases the margins and that alleviates the situation. So those are the things that you want. So ultimately, at the end of the day, you're looking at the ARBs into Europe if they're suddenly to be open again or not.
I was going to go back.
Yes.
Yeah, I was going to go back to answer to very specifically try and answer your question, Felipe, about kind of the HOGO, right? Is it the US going to come off, or is it gas oil coming up? I think that we're saying it's gas oil to look at that will we're more likely to see gas oil coming up than heating oil coming off to narrow that HOGO again, and the kind of the limit of that, or the time to kind of think that maybe gas oil upside has reached a good level is when we start to see those marginal east-west arbs, those marginal kind of AG arbs pulling into Europe again, which they are, $2 away from doing at the moment. And obviously when we start to see the Gulf Coast moving open into Europe, which again, it's 5 cents per gallon off at the moment. So there's a decent kind of upside, I think, for ice gas oil on both of those before you start to see flows really coming back into Europe.
By the way, talking about flows and timing, obviously, because timing is super important. Are we still? I should know this, but I don't really. I'm not following the market as you guys. But are we still going through Cape, or is now Suez back in action?
It's a very good question. We're still going through Cape, even though that we've essentially the thing that should change that should be a proper Gaza-Israel ceasefire. I think from what I've heard that it will take time before
people feel
vessel owners with their insurance companies have the agreement to move back through the Suez again.
Okay.
But
so again, that's almost a month voyage, or more than a month voyage to get to Europe from the Middle East. Yep. So any kind of reaction will take a month to, so when we're thinking about potential spikes in the market, the only quick resupply is Houston or the Gulf Coast. That's the one you want to be monitoring in terms of to put a cap to any kind of spike in the market.
Again, and this is one, we've actually published a white paper about this, about how well our US Gulf ARB calculations predict forward moves in ice gas oil spreads.
Correct, yeah.
Again, as Phil has mentioned, that ARB is massively closed. Again, it's another trigger that makes us want to be bullish ice gas oil spreads.
Fair enough. And particularly in winter, yeah. Mm-hmm. Okay. Anything else you think is worth mentioning?
Sure. I always feel like we kind of just add jet on the end. But yes, I guess I think the kind of weakness that we're seeing in jet now is exemplified by the dramatic widening of the Singapore regrade that we continue to see. We should see some relief here. I think jet being blended into diesel at these levels, particularly because that helps with like winter cold properties, reduced Japanese kerosene stocks that we're seeing due to like heating demand that we're talking about cold temperatures now during the winter. And also, I guess the fact that we've seen these arbs open into the US Atlantic coast that we've spoken about before as well. But still, with all those factors, I think it still feels like pretty bearish from here actually moving forward. So I think we should probably expect to see Northwest European diffs and spreads continue to come off over the next period of time.
Okay. Should we move on to crude or,
sure.
Crude, maybe
I've got I have an update courtesy of our esteemed freight colleague Michael Ryan. So just run through that very quickly. So obviously, we talked. It was the dirty freight rates that were the first, obviously, to spike when you take out 100+ vessels from the dirty fleet, even if it was kind of a bit of a shadow fleet. That being said, over the second half of last week, we started to see that turning around again. So TD3, TD20, kind of big dirty routes have dropped about 10% over the second half of last week. And there has been a big discrepancy between the larger dirty vessels, so the VLs and Suez, and the Aframaxes. So Afra rates actually came off quite a bit, and that has meant that TD25, for example, that Gulf Coast into Europe, those Afra rates are already kind of back below pre-sanctions levels. So there seems to be lots of Aframaxes available in the market, but the VLCC rates are still doing pretty well. So going forwards, it looks like for those classes in particular, we've got a new kind of higher baseline floor that we should expect to keep, although maybe some of the spike that the initial spike we saw can keep coming off. So near term, we can kind of continue to drift a little bit lower, but returning to a kind of just a higher floor than what we had before. And actually, luckily, Michael kind of has given his insight on what we just talked about before about Gaza truce and what that means for the Houthis and their kind of actions around the Red Sea. Yeah, Michael seemed to think that kind of it's going to take one brave, almost canary in the coal mine to make that run a couple of times. And that's going to start to then maybe it will then take time, probably a good couple of months, for owners to start building up their confidence, for the insurance firms to build up their confidence again that is really a route that is back open.
Thank you very much for that. So those higher DPP rates have been driven by a scramble to secure additional cargoes out of the AG in order to cover the Asian March and April arrivals. So has this market also started to cool in line with those DPP rates, as you mentioned, or are we seeing something different in crude? And maybe we could talk again about this discrepancy with WAF. Tell us a bit more about the crude market.
Yeah. So it has been essentially one for one replicated on the crude side when we're looking at the FOB premium for those grades that are loading kind of February, March out of the AG. So Oman, for example, the premium shot up to over $5 a barrel against Dubai last week, has since tapered down to the mid fours, and that's kind of a pretty universal picture now for those premium. So Murban premium have also come off maybe 10-15% since last week. So it looks like we're kind of getting to the end of that very frenzied grab what you can kind of scenario when everyone was trying to cover that immediate late March, early April arrivals window that was the most directly impacted by the loss of those Russian barrels. And then I suppose so the next question is, what's next, right? And why is it not that we can just run lower or replace maybe some of those medium sour barrels with the lighter grades that are coming out of North Sea, US, even some of those WAF grades. And there it's actually, I suppose this is more of an explanation as why we saw these very high premia and why they were kind of justified, is because there is actually a really big penalty for shutting down units. So if there had been a real shortfall of residue-rich crudes available to a lot of these refiners in the East, then maybe they could have still run at 80%, but one or two of their secondary units would have had to be shut down. And as soon as that happens, and you want to then restart it again because margins pick up quickly, it puts a lot of strain on the unit itself. So it's economically and kind of operationally very intensive. So they wanted to avoid that. They have now avoided that, it seems, in the most part. So those vessels that were sanctioned and would have arrived late March, early April have probably been covered now. So now we look at the next stage, and the next stage is, okay, those barrels are out of the market for a while now. We've seen various pieces of analysis about certain grades, so Sakhalin grades, and which grades, Espo as well, which grades are kind of out because of the ships are missing that needed to be doing that, and which grades can still kind of have a workaround. But essentially, we're going to be missing heavier barrels. We're going to be missing residue content into the East, both for China and for India. And now the question is, okay, what do you replace that with? First thing to note, it's not you can't have a 1-for-1 replacement. You can't replace Urals with WTI, right? If you want to make a Urals kind of spec grade that your refinery is happy to run with, then you need to blend 30% TI with 70% Basra heavy to give you a kind of Urals equivalent. So it's not a 1-for-1 replacement, which is why we need to keep on seeing these light heavy and the sweet sour diffs narrowing, and why we also need to see a narrower Brent Dubai EFS going forward. Obviously, that's partly a quality differential, but it was also partly a ability to bring crudes from the West into the East going forwards.
Okay, so looking at the US, how drive us through the impact, and obviously a combination of WTI with other grades, etc. But what about Mars? What about other crudes? What do you tell us about it?
Yeah, so I promise we'll get to WAF in a minute, but the first, or one of the biggest impacts that we've seen from our crude dashboard is seeing that actually the US crudes are landing very attractively into the East now. That's partly because VLCC rates out of the Gulf Coast remain relatively workable, especially those going east. The market wants to pull VLCCs into the east of Suez now. So that Mars in particular, the arb looks wide open into Far East when you're comparing it against Oman or kind of similar grades. So we should see the Mars FOB premium reacting if the Gulf Coast wants to keep those barrels domestically, which, again, kind of going back to tariff potential and US Gulf, everything John mentioned last week about Gulf Coast missing heavier barrels, it will almost certainly want to do. And WTI is also looking extremely workable into the east. And we've seen people like Taiwan's CPC picking up a lot of VLCCs in the last few days. So interestingly, we're building a kind of, we're learning more and more about our own tool as we go along, and picking out the signals from it. John was saying today that actually WTI is landing cheaper than Murban at the moment into the Far East, which has only happened 3% of the time in our data so far. So definitely a strong kind of buy signal there, whether that is TI versus Dubai via kind of TI Brent and Brent Dubai, or whether that is just MEH diffs, so water kind of WTI the coast. WTI needs to price higher because it's pricing very attractively into Europe and into Asia at the moment, and it's quite tight in the US.
Interesting. Okay, well, yeah, that's something that, again, historically, no one really had this information. And I think it's worth mentioning that it's not just about knowing what the prices of the WTI or Murban were, but what were the values of these on a historical basis. Being able to know that it was open or relatively open versus Murban only 3% of the time is a significant information that, again, not always have available, even in the big shops that they haven't really been storing data on outputs, refining margins, arbitrage margins, blending margins, and things like that. But okay. Oh, and so yes, you promised WAF. So please deliver. What?
So just there are a couple of WAF grades that typically go into China, things like JNO, Hongo, Dahlia, and those have already seen actually their FOB premium rise by about $1. So what we haven't seen so far is the rest of the WAF grades reacting substantially. I think there's a couple of reasons for that. So the first thing that happened when all the pricing kind of readjustment started happening is that we saw VLCC rates ticking up. We saw CFDs, so dated related pricing, move higher. We saw that wide Brent Dubai EFS, which made west of Suez crudes more expensive in the east. And we saw very strong Dubai backwardation. So essentially everything that was going to take, even a week or 2 weeks longer, going to get relatively hurt by that big backwardation. So it meant that the FOB prices, kind of the printed FOB prices on WAF crudes couldn't really move higher because it was being made more expensive in other ways. All of those things have started to come off. So the VLCC rates, the CFDs, the Brent Dubai AFS, even I think to a certain extent now the Dubai backwardation, all slightly coming off, which means that we're entering a new trading cycle for a lot of these WAF grades now, and we should see new kind of FOB premium getting set. So essentially, kind of the message here would be, if you're sat on WAF cargoes, especially some of the heavier ones, then maybe don't just go and look at whatever your latest PRA print was. You have potential upside going forward when you're looking at now kind of April arrival barrels into the east, and it's because Murban is still so expensive, right? Murban is and other Middle Eastern grades, but we've seen kind of now that this buying cycle for the AG grades is cooling off, that attention really should move to WAF now, and or kind of Black Sea and maybe even North Sea grades.
So you're summarizing your crude calls, would, correct me if I'm wrong, narrowing the Brent Dubai EFS as Dubai structure comes off.
Yep.
Support for WAF grades, specifically the heavier grades, at least on the premium level. WTI Brent to remain narrow or even narrow further on the back of WTI open into Northwest Europe and the Far East. Surprisingly, as we've said, on a 3% only, despite, and this is important, despite the tight Cushing US balances, no?
Exactly, yeah. So it doesn't seem kind of fundamentally feasible, right? Or fundamentally justifiable that you have WTI quite so workable into Europe and into the Far East when you've got the US balance so tight, and actually when the Asian market doesn't really seem to be wanting kind of lighter crudes at the moment.
Yes, which is the anomaly. But one thing that we haven't really touched too much upon is the cracks, and it's a good segue into gasoline. But why do you think the cracks, have come off so much? Is it just products haven't followed the strength in crude, or is there a more fundamental story around demand? Jorge, Phil, maybe you can both comment on this, and then Jorge, we can move on into gasoline.
Yeah, well, it's particularly interesting your comment regarding the East of Suez levels right now, because we have seen a correction in Singapore 92 complex, crack and also time spread that we were not expecting. And I've been talking with Phil during this week, trying to guess what is going on. Are we missing something? Because if we add like all the fundamentals together, there is not a reason from the crude side to see this. There is not a reason from the freight side. We have seen increasing levels of freight in the east, more on the dirty side, but also on the clean side. Yeah, and these corrections comes after a very big uptrend, especially in time spreads, which has been increasing since October for the February and March time spread. And the main fundamental reason that I think that can be behind this weakness in the Singapore 92 market, it's on the AG stocks. Looking at the historical levels, we have seen the biggest builds for 2 consecutive weeks for the 2 previous weeks. Looking at the historical since October to now. So we have seen increasing stocks in AG, and I think they have been big enough to lead the market to this very pressure. But
sorry, Jorge. I also saw that news, and I mean those are we're looking at that. You're referring to the Fujairah light end stocks that they saw a couple of weeks of builds at the beginning of the year, but then you look at Singapore. Yep. And the Singapore stocks are the lowest they've been since mid-December or whatever, when we were in a solid backwardation. We've not heard any kind of indication that China is suddenly, exporting a lot more than anyone was suggesting. Indian, refiners are going to be struggling moving forwards. Chinese refiners as well. So the implication is that at least for, March, April supply shouldn't be fantastic, or certainly shouldn't be higher than anyone was expecting. And, the demand in the East is not terrible. We've not seen kind of new data points coming out which tell us that the demand is terrible. The inventories in Singapore and Japan that we see on a weekly basis look completely fine or supportive, So it is puzzling, for me at least.
Yeah, I agree totally with the Singapore stocks and the China data. There haven't been a signal from them pointing to this sharp drop on the Eastern market, and I think that take us to our call of this week on the gasoline market. That will be a reversal on this trend on the East-West. I think right now, looking at the fundamentals that we have been seeing, and also linked to the refining margins and how they look in the East, which is something that James have already commented, and also Phil. I think we will expect this trend to be reversed, and we will see higher levels of East-West in the next weeks.
East-West, and also maybe spreads. I mean,
and spreads.
Do we actually know what happened? Why suddenly this drop? Is it just on the back of, okay, the crude story I can understand, in the sense, okay, crude went up, products didn't follow, cracks come off. Okay, I can understand that, and it can happen during a week, and then it bounces back, and we know in 1 week we're back to normal. But why this impact on time spreads? That's going from healthy, in line, again, we're talking about fundamentals, in line with stocks being lower, talked about China not exporting that much, or what's the story? Why suddenly this happened? Do we know? And maybe we need to investigate and come back next week. But I'm puzzled here why this happened on time spreads.
Yeah, we've been investigating during the whole week, and I think I would summarize 3 things that point in that direction. But for me, they are not enough, maybe to see that drop. But on the first point would be AG stocks. I have already talked about it. The other point would be ARB from Europe. Last week, some European exports, some qualities were supplied better from Europe than from AG and Singapore into East Africa. So maybe that can be another fundamental. And the other one can be a sell-off on time spread after a very big rally. If you look at the February-March time spread, it has been climbing since middle October. And then we have seen very big corrections taking us back to the December levels, to middle of December levels. So these are the 3 things that I think I have found about this history.
Okay, so it seems like, hence the call. It seems like a buying opportunity here, or an overreaction, if you want, that doesn't seem to be fundamentally justified. Because again, the Fujairah stocks, it's normal. If the ARBs were open from ARA or from Europe into East Africa, Middle East, etc., it is normal for Fujairah to go up. But again, in order for that to have an impact in the pricing center in Singapore, you need to wait. You need to see a bit more timing, You
Yeah.
need or actually the Fujairah, arb into Singapore to be open, which I don't know if we checked, but
No.
doesn't happen very often, extremely rarely. But if it does, then you can actually start moving LR1s, LR2s in a very short time frame and affecting the market very quickly. Yeah.
Yeah, I mean, talking to a couple of traders this week, obviously, and trying to kind of get their opinion on it, you notice there are times when prices move quite quickly, and you talk to traders about it, and they give you very specific answers about why it happened. This week, a lot of the answers have been there's a lot of there's a lot of oil for in Singapore. There's a lot of gasoline in Singapore. Yeah, okay. Where does it come from? I mean, as Jorge mentioned, arbs from Europe were into the East of Suez were open consistently from November, right? And so also for February and even early March arrival as recently as a week and a half ago. So there is probably and it's it has to go around the Cape. So these things take time. Those arbs are already on the water, so there is still volume moving west to east, and yeah, maybe it's just a little bit of an overreaction now to kind of definitively shut that off for the rest of the quarter.
Fair enough. And new sanctions, on vessels carrying Russian oil. Obviously we've talked about the impacts on crude, but what are the impacts in Singapore 92 and gasoline overall?
Yeah, the main thing we've seen so far is freight racing from AG to Singapore, and on the general East of Suez freight. It points in a different direction than the movement in Singapore 92. We should see higher prices for Singapore 92 linked to this freight, and also linked to the historical high prices on the East of Suez crudes that Phil has been talking about.
Yeah, absolutely. Let's not forget that Singapore it's a pricing center, but it's a delivered pricing center relative to ARA or Houston that are, the production is made locally and therefore is less impacted by freight or actually on a reverse basis. So yeah, it again, surprising. This is something to think about. Maybe we're missing something that we don't know, but with the evidence that we have right now, it just does not make sense.
The last point to add on to that would be that we see sometimes that the physical premium, because we have access to the physical component premium, whether that's in ARA or Houston, it can sometimes front run the paper, or at least it moves in tandem. So far, we haven't seen any kind of noticeable drop off in component premium in Singapore. So from a kind of physical market perspective, it also seems as though maybe that paper movement is a little bit too strong.
So does that open on actually being so cheap relative to other areas? Do we see now opportunities for at least exporting into also the West Coast, South America, Mexico? What are you seeing there, Jorge?
Yeah, we have seen a lot of changes in the export position of the East of Suez have improved a lot after this downtrend in the East West, and yeah, Singapore is right now the best option into Mexico and also into Nigeria. If we look, the comparison would be MR from Houston, MR from Europe, and LR1 from Singapore. But an LR1 from Singapore would land cheaper into Nigeria. And if we look into a pure MR comparison, it's not that far. Even AG is not that far from Europe. So
what about LR1 versus LR1? So if you compare an LR1 from AG or Singapore
cheaper from Europe.
It's cheaper from Europe.
Yeah,
okay.
But I mean that was a kind of $30 or $40 per ton difference last week, and now it's more like a 10 or 5 or 10 different dollar per ton difference.
Yeah.
So
I think
some people might be able to make that work. Yeah.
Yeah, if we look at the MRs, it's just like $3 or $4 per metric ton difference between Europe and Singapore. So yeah, the difference is really tight. I like the comment that Phil has done before on crude, like the percentage of time in the historical that this happened linked to the ARBs. So we are right now seeing something that is not common on the arbitrage to West Africa and also to Mexico. It is also this landing much cheaper than what it's usually doing. So this is one of the reasons behind our thoughts about there could be a potential a reversal on the east-west trend. Also linked to the physical comment that Phil has done. The physical market haven't moved as the paper one.
For sure. And again, I can guarantee you there's a lot of people looking at this hard right now.
Yeah.
On LR2s. That's the beauty of WAF is that you can send LR2s and there's demand for it. So there's a lot of people looking into this. So yeah, something to monitor as maybe that is the sort of leading indicator that you want to look at that will, if the ARB on an LR2 becomes, or LR1 starts to compete with an LR1 in ARA or even MRs and things like that, that's the sort of trigger point for maybe the rebound to start happening. I'm happy to bet a lunch on that. Cheap lunch, cheap lunch.
No such thing in Geneva.
Yeah, there's no such thing in Geneva. Yeah, true. Okay, moving on to the West. So EBOB, you said reduced, the contango. Tell us more, obviously it was at, -7, -7.5. Now it's rebounded to -5. What's the story there? Is it actually significant? Do we actually care or not really?
Yeah, I think there's not going to be a massive change on the EBOB market. I mean, contango is going to keep being like the main operation right now, especially after some ARBs today are now closed. And also the competitiveness of Europe into Latin America has decreased compared to Houston, looking at last week levels. Last week we saw at the beginning of the week a difference of 5 cents per gal Europe cheaper landing into Brazil. Right now the difference is very small. So yeah, there are no reasons like for a big rally on the European market. I think the biggest support can come from the US Gulf Coast. If during this freeze period they can export less to Latin America, maybe we will see the opportunities of Europe in exporting into Latin America increasing.
Okay, yeah. Not a very non-eventful winter for gasoline in Europe, I have to say. I mean, there was a little bit of a spike following the shutdown of Colonial last week, which got people excited about potential ARBs into New York. But again, those things are generally short-lived, except there's an explosion or anything like that. But so again, I think to summarize and move, gasoline before we move quickly to naphtha. There's a story there on 92 spreads, on East-West, on cracks. There seems to have been an overreaction that doesn't seem to be justified fundamentally. So that's an opportunity. Gasoline in Europe, again, with -5, -7, it could be -5, it could be -7. With the information that we have, we cannot make a call on that. But definitely it's any kind of ARB into AG is now completely shut down. It is not economical into Latin America. So, the only destination is tax. So if your call is -5, -7, you're right.
Yeah, blended locally is also close for 45 and 10. So
okay,
there are not many options. I think contango will keep being like the main option right now.
Yeah, and again, let's not forget, if shipping goes up, which seems to be the case, as everything trickles down from DPP to clean, from large vessels to smaller vessels, Europe, in order to be competitive, needs to bring down its prices to then absorb the higher shipping costs, So hence one more, let's say, bearish side on the European spreads or cash divs, etc. Yeah, okay. Naphtha, before, let's wrap up with naphtha.
Yeah. I'm gonna be quick on the naphtha market. Not many things have changed during the last couple of weeks. The market we saw a rebound in the time spread, both MOPJ and in Northwest Europe, and right now we have seen a little bit of correction. The ARB is close to the east, and the main movement we have seen has been in Northwest Europe cash dips. We have seen a big downtrend there, and they are back to last year lows that we saw at the beginning of December. So right now we are in a moment where the ARB is close to the east. We have seen a decrease also on the cash dips in Asia. So I don't think we are going to see the ARB open in the next weeks or in the next month. So there are not many. There are concerns about petrochemical margins. So there are not many reasons to be supportive on the market. My main thought right now is that there is a big difference between the paper and the physical in Europe. We are seeing a backwardation of +5, +6, while the physical premium in the prompt is at -10, which is the lowest level we saw during 2024. So the market on the physical side is very, very weak, and I think we will see some corrections on the time spreads in the short term.
Okay, this has been a long episode. That's very interesting, I have to say. Anything to add before we wrap it up?
How many people are still listening at this stage, to be honest? I don't know. I tend to zone off podcasts after about 45 minutes, so I'm wary of saying anything too interesting now, and people not hearing it.
So keep it for next week then. It's with the hope that it's still valid.
We'll open next week with some bangers. Yeah.
Okay, James, anything on your side?
No, I think that we covered it all. Thanks very much.
Fantastic. Well, guys, thank you so much, and looking forward to speaking to you next week. In the meantime, thank you very much again. Yeah. Cheers.
Thank you too.
Thank you, Felipe.
Good one.
Bye.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.